Hello everyone, this is Professor Kent. Today's recording is Learning Capital Cost Allowance. It's a chapter 5. In short, capital cost allowance is a CCA. Now, just before we start with the CCA, when we think of it, you have done accounting courses. Under accounting standards, what we do a depreciation expense, and that we amortize expense. Under the income tax, we use CCA. Under the income tax, we use called CCA. It's a deduction from our income before we arriving to taxable income. So when we think of this is an introduction, the asset only applies, CCA applies to the depreciable assets. So when we think of the following items are not included as a depreciable property, they're not eligible for CCA. If it's not a depreciable property, we cannot take CCA. They said first one is capital expenditure allowed to deduct in full. So if there's a landscaping cost, and what we have to do is we're under the income tax, we're allowed a full deduction. So we're allowed a full deduction the year the expenditure happens. We have an inventory, it's not depreciable, then we cannot take a CCA. Property not acquired purpose of earning an income. If you have a property you acquired for an investment, we cannot take a CCA for that. Land does not depreciate. Then any other capital asset that are non-depreciable. Any animals we cannot depreciate. Trees, scrubs, herbs, or similar growing things, they are not depreciable. If they're not depreciable for the accounting purposes, they will not be eligible for CCA. So now this is where what I was going to say, that now accounting, there's a difference between income tax and accounting principle. The company could be following different standards for accounting, but where there is an income tax, what happens is that income tax operate largely on a basis of legal concept and principle, not an accounting concept of principle. Now, accounting based profit or loss is converted into net income. So what we do is we produce an accounting income. You might learn it in your intermediate 2 class when we talk about deferred taxes. What we have is in accounting income is produced using an IFRS standards, or company could be following an ASPE if it's a private, or we call it a GAAP principles. That's where we do it. We adjust this accounting income, and then we call it taxable income or the income for tax purposes. So what happens in this case, they both are going to be different. So that's what we are trying to do. We're trying to do one difference, and what that difference is. Under the accounting, we do a depreciation, and under the income tax we do a CCA. And that's what the next one is. The objective of this chapter is CCA versus objective is CCA versus depreciation concept. Under accounting, we match the cost over expected life of the depreciable asset. And income tax provided targeted incentive to encourage business to write off these expense, ignoring the useful life. We don't use the useful life, but we write it off. But we use a different way of writing it off. That's what we do. Going further, what we have is this is a good chart. What is this chart? We're trying to compare my accounting income tax terms and my accounting principle, and that is compared. Now when we think of it, you know this, when you purchase an asset is the cost, and then what we do is we amortize the asset or depreciate it. The difference between the both is my carrying value. Now the terms that are used under income tax, here is a cost, and here we call it a capital cost. Here it's a minus the amortization or depreciation, we call it CCA. Difference between those two numbers, we call it undepreciated capital cost, UCC. We call it a UCC. So this is what it is. So that's the terminology that is used, that we compare when we compare the accounting to income tax. Going further, now same thing, cost of the capital is tracked individually to determine the annual amortization. Then carrying value and whether gain or loss when it is sold. So if when do we have a gain? If the carrying value of the asset, you have a carrying value, and then we call it proceeds. When you sold that asset, that's another way of saying it. I don't want to use proceed. We do use proceed in a or proceeds of disposition in income tax. Carrying value of the asset, let's say, is $1,000. We sold that asset for 2,000. What do we have? We have a gain. If it's the other way around, the carrying value of the asset was 2,000. We sold it. We have sold it for 1,000. We have a loss, and this is what they're saying. Now, how do we get the carrying value? We have a cost of the asset minus your depreciation and equal to my carrying value, and this is called an acquisition cost, the costs at the time of the purchase. Under the income tax, it's just saying the same thing. What happens is that you have a UCC of each class, so is depreciable. So we have a class for each depreciable property. We're going to learn more again. The class, there's so many classes that are given to you in your book, and you needed to memorize some of them, but once you do it once or twice, they come very naturally to you. So under the income tax, this is what the next slide is just explaining these two. Under accounting, the names of these ones. Now I already did this. If you have a proceeds less net book value, you could have a gain or a loss. Now under the income tax, what we do is we call them terminal loss or a recapture. If you have we call it a gain, we call it recapture. If you have a loss, we call terminal loss. Now what happens is that it has to be, we have in a class we can have a pool of assets. If all the assets are sold from that pool, you could have a recapture or you could have a terminal loss. We'll do examples at the back of the chapter, or do some more questions in order to do that. Now the difference between the proceeds and the capital costs can also result in a capital gain, or there's no effect. So you could have a capital gain or you could have a no effect. So let's do next. What is included in the capital cost? Again, we're talking about income tax. When you talk about income tax, we call it capital cost of buying that asset. So when you do that, what is included in there? The freight, the installation costs, and the duties, any legal, accounting, appraisal, engineering, or fees that are acquired. So that will be all included in the cost. So that's what full cost of acquiring. Then what we do is, addition to capital cost, what we need if we had to finance the asset, what we do is elective option to add the interest, because we want to capitalize it. If we want to capitalize it, we needed this interest that should be included in my cost. Any interest that we're capitalizing, it will be included. And if you get a government grant for this, you get a grant, subsidies, or forgivable loans, that we have to deduct it, because we cannot use a CCA on that. Going further, we call it a half year. So half year income tax rule that limits, restrict, or delay maximum CCA claimed in the year depreciate property is acquired. The year you purchase the depreciate property, we call it something called half year rule applies. So the year you purchase an asset, you are allowed only 50% of the maximum CCA. We call them half year rule applies in the first year of a purchase. Now, on November 28, half year rule was temporarily replaced. So we used to only have a half year rule when the COVID happened. Then what the government did was that we were allowed 150% of the maximum CC. So it is changed. The 50% is changed to 150%, and then this rule is also going away too, so it will be ending in 2027. So it will be ending in 2020 when we say accelerated investment initiative. So the ACC double II stands for that. Now what happens in this case, when we do that, what it does is 100% allows 100% of the capital cost of most depreciated property to be expensed in the year of acquisition. Means you can take advantage of the asset you bought, which is a depreciable asset, and you can write off 100% in the year of acquisition. So what is accelerated, when we think of an accelerated investment initiative, what it does is it overrides both the half this one writes both the half year rule and the ACI, and we call it, we can immediately expense everything that we purchase, and um, that is temporary in nature, applies to either December 31st 2023 or December 31st 2024 year. That's what it's applied to. When we think of it, we could have a short taxation year. Means if you open up your corporation on June, and you want the year ended to be December, so the first year is a less than 365, so we call it a short year. Or you can take it to next year in June, and that will be a year, so we know this is a year. But if you want your year end, first year end, to be December 31st, and then it'll be 6 months, right? So if it's going to be 6 months, we call it a shorter year. So there's a different rules for shorter year. When we do a CCA, you have to prorate your CCA according to your year end. So that's what happens. Now when we talk about separate classes, so depending on the asset, they fall under a different class. That class has a CCA. Every class has a CCA that we can write off as a CCA in the year. So this is some of the examples. So these are some of the depreciable properties that are used more in a real life situation. So if it's a residential building, so what happens is the CCA we were taking was 4%. Now there's an increase to 10%. The new 10%, the rule is that the construction has to be begin after the April 15 24, but before the January 1st 31st, and available to use for December 31st 35. This is for the residential, like apartment buildings, when we think of it, residential buildings. Then the other rule, the new thing is that with passenger vehicles. So if you have an asset, what we're doing with this asset is, if you're buying an asset, if it is a passenger vehicle. So in passenger vehicle, we can have a luxury vehicles, new and used. Now when we think of it, when passenger vehicle that have a cost more than 37,000, what the income tax does is, we're limited to take a CCA, even though the cost is more than 37, but in the cost that we can take CCA on is the limit. In 23 limit was 36,000, in 22 the limit was 34, and prior to 2022 the limit was 30,000. So this limit changes every year. So if a company buy a luxury car, or they buy a vehicle, new or used,
they can spend as much cost they want, but according to Revenue Canada, the max amount that you're allowed to take a CCA will be 36,000, because we're working with 23 numbers. So now these are some of the common classes in class 1. So in class 1 we could apply 4%, we can apply 6%, we can apply 10% CCA. Now how do you know when, if you should take 4%, 6%, or 10%? The way to do it is, when this building was acquired. Is it after 1987, or acquired after 2007, or is acquired after 2007? So this is what happened when you have it. These are the rates that we are allowed to take a CCA on. If you go to the back of your chapter, you will know what applies to it. So in this case, these both are same. If they both are same, in the class the assets are different. So in this case, it is a new building and a non-residence, and used 90% or more for manufacturing and processing. This has more for manufacturing or processing. Here there is a less. In this case, new building 90% or more, non-residence not. If it's not a manufacturing, then you are allowed 6%. If it's a manufacturing, you're allowed 10% CCA. So this is how it's different. My next class that is more common is class 8. What does that class 8 has? We are allowed a CCA of 20%. It includes any machinery, any equipment, any tanks, any vats, any electrical generating equipment, any advertising poster, bulletin boards, furniture not included in another class. We call it furniture and equipment. They come under class 8. Class 10, we're allowed to write off 30% a CCA. And what does that include? It includes motor vehicle, any automotive equipment, trailers, wagons, contractor movable equipment, TV channels, converters, and other ones. What it does is it excludes any passenger or luxury vehicle. If they excluded, they go under the class 10.6. And if 10.1, and that is also 30%, but they go under that. If you own a taxi cab, then your asset will go under class 16. Any zero emission vehicle, they will go under 54 or 55. Now this is what I was talking about. Class 10.1, we write off 30%, but that applies to luxury cars or automobile. Now the cost, if its cost is more than 37,000, we are only limited to, and the limit is, we just talked about it, limits are here. So this is something you needed to memorize, what the limit is for every year. So if you're doing it this year, so the limit, all your questions at the back will be 36,000. So that's what the limit will be. Now the difference here is if you bought first asset, you will go under class 10.1. If you bought another one, it will have a separate class. So every asset that I bought under 10.1, every automobile or luxury is bought, each has a separate class, and there is no terminal loss. So we cannot generate in terminal loss. But we're allowed 50% of the year of disposition. The year that we sell, we are allowed to take a 50. If there was any UCC left, we're allowed to take a 50% of the year of disposition. There's no recapture. So no recapture, no terminal loss on the passenger vehicles, which is class number 10.1. Now we have a class number 12, and then we are allowed 100% CCA rate, means whatever you purchase, you're allowed to write off the full capital cost of that asset. What does that come under? These are the examples that comes under this class. It's a computer software, books in library, dishes, cutlery, any spoons, forks, any uniform. These are for the people, the chefs. Linen, if they're linen is hotel and management. We have motion pictures and files. Any tools that cost less than 500, they come in this. So we're allowed to write off 100% the year that these assets are purchased. Then we have a leasehold improvement. When we think of a leasehold improvement, it is goes class 13, and this is the only time we use a straight line. A capital expenditure made by a tenant to a leased property. If you're making a change to the leased property, we call them leasehold improvement. Although the property does not belong to a tenant, but allows a CCA to be claimed. So when we do a CCA claimed, each leasehold improvement is have a separate class. So it's a separate property. So you could have more than one class 13 asset. So what we do is the maximum CCA will be lesser of these two numbers. So what you're going to do is whatever the cost is, then you multiply by 1 over the 5. Then the capital cost of leasehold improvement divided by the lease term. So whatever the lease term is, what we do is we divide it, and then we're allowed one renewal option. So we're allowed one renewal option in income tax. So we take the lesser of these two, that will be the maximum CCA we're allowed to deduct. The other common class that is used a lot is class 14, and we use a straight line for that too. So we use a straight line. So it is for what? It is for limited life intangible asset. What are intangible assets? We have patents. We have a patents. We have a patents. Sorry, we have patents, franchise, and the other one here is your concessions or a license. So they have a limited life. If they have a limited life, oh sorry, it came back. I was going to take my pen apart. It used to have a limited life. Now if I were to think about it, everything has a limited life. The only thing this applies to the patent. All patents, whether limited or unlimited life, are now categorized under the class 44. We take 25% of the CCA. Now we have as a taxpayer, we have a choice. What is our choice? We can elect to put them in class number 14. So class number 14. So this just applies to patents, only applies to patents. The other one is your franchise and concession or a license. We do it over straight line. Now my next class is my class number 14. What goes in that class 14? We have a goodwill. We have an incorporation cost, which when you start a business, you incorporate your corporation. That's what it is. You buy customer list, means that you take over, if you're an accountant, you take over another company's customers, that we call a customer list, or any unlimited life. So then what we do is we're allowed to take 5% of a CCA. Now the next one is your class number 50. The CCA rate is 55. Again, these are most common ones. The one I talk about it, these are tested more, and these are used in the work field more. So the other one, what includes in this class? Hardware and system software that are acquired after January 31st, 2021. What is it? Includes any computers, laptops, smartphones, tablets, and other devices. Also equipment that require internally stored computers programs for its operation. We're allowed to take a CCA of 55%. Going further, we have a manufacturing and processing properties. So they go under the class 53, and it is the CCA that we're allowed is 50% CCA that we're allowed. So it is any manufacturing or processing property that was acquired after 2015 but before 2026, but it has to be used in Canada. So this has manufacturing property. If you have another subsidiary that is in the US or somewhere else, it is only applied to if we use this manufacturing processing used in Canada more than half of the time of the purpose of the manufacturing process goods sold or leased. So we're going to produce the products, and if the product that is sold more than half of the time for the purpose of manufacturing. And then what happens is, if that's the case, we're allowed a 50%. Now it says class 43 includes eligible machinery and property that would not be included in 29 or 53. If you put them in 43, you cannot use it here. You cannot use them here. So you cannot use them here. Now, when we think of a half-year rule, now the before 2018, we say pre November 21st, 2018, full CCA claimed on depreciated property no matter when it was acquired in the year. This was a, so then doesn't matter when it was acquired in the year. So half year rule was applied. So in order to fix the problem, what happens is that the solution is to reduce UCC base at the end of one half of the net addition. So when we think of a net addition, you're buying and selling in the same year. So if you bought it for $10,000, you sold something for, let's say, $25,000, you have a negative of 15,000. Your net addition doesn't apply to the negative, it only applies to the positive. If I purchased it for 12,000, I sold something for 10,000 and 15,000, we call it net addition. So when your net addition is, you're buying and selling. If your net addition is 15,000, half year rule applies to the net addition. So that's what happens, the net addition. Now the half year rule does not apply to class 12, whereas tools are less than 500, or uniforms or china wares. It does not apply to that. So it does not apply to class 12 or class 14. It does not apply to that. Now this is also another one. This rule is revised. The half year rule is revised, is saying that what the revision is, instead of reducing UCC balance at the end of net addition, the accelerated increases the UCC for CCA purposes. Now if you revised rule retains half year rules for depreciated property not eligible for AC. If you're eligible for ACC, accelerated investment, then you have zero emission vehicle, this half year rule does not apply to them. Now these are the three alternatives that we have. First of all, we needed to the possible alternative exists for the first year of addition. Verify whether the accelerated incentive is applied to them. If it's applied to them, these are the possible things, right? If it applies, if it doesn't apply, determine the half year rule. If neither applies, CCA is based on the rate of that class. So either you take 150% of it. If it doesn't apply, then you're allowed a half year rule. If neither of the two applies, then what we do is whatever the rate is for that particular class, then we can write our CCA. Going further, accelerated investment in incentive eligibility. We have to, this is a flow chart that is available to us. They saying what's depreciated property other than zero emission vehicles purchased between November 21st, 18 to 27. Your answer could be no, or your answer could be yes. If your answer is no, then we go to number 5. If your answer is yes, you go into this order or where the yes is going, right? If you could have a yes or no answer. So if we say that was CCA or terminal loss claimed, if you claimed it, yes, you go this route. If you did not claim it, you come in here. So this property qualify for ACC, um, accelerated incentive investment. So then if you had a CCA or a terminal loss claimed, and then you go here, then the rollover applies to previously owned purchases, and you could go from yes goes to the does not qualify. The prop what we are trying to do here is, does the asset qualify for accelerated investment incentive or no? We don't know which route we are going to take, but you needed to test it and you needed to memorize it. So the way I always think of it, I think of it first. We think of it. Sorry, I'm trying. So the first thing you're gonna, when you do that, you look at it. You if your answer is no, then you go up here, does not qualify. If your answer is yes, either you go this direction or you go this direction. If you're going to this direction, then you are not going to be qualified if your answer is that. If you're going this direction, if your answer is no to that, you qualify. So this is the flow chart that you have to do for if you're eligible for accelerated investment incentive, which is 150%. You could tell that I'm trying to move my my computer, my sheet, but it's not moving anything. So let's go to my next slide. And what is my next slide is telling us to do? I'm gonna try to see if I can move my screen, because sometimes my screen is so my next one is my class 14.1. So this is the one. My next one is my class number is 14.1. When we think of a 14.1, it's a goodwill. Goodwill, when we think of a goodwill, it is goodwill is for being good to the business. So when the difference between your purchase price and the fair market value of unidentifiable assets acquired on a business, if you pay more, then if your purchase price is excess of the fair market value. If you pay more, the purchase price is more, then we have a goodwill. If it's a less, we call it a negative goodwill. Now if goodwill cannot be internally generated, if it's generated internally, it doesn't cost you anything. You cannot have any capital cost for the tax purposes. Now goodwill, for if you have more than one business that you purchase, we have to put each one in a separate class. So if integrated business, one single goodwill account is created. For the tax planning purposes, of course, we wanted to reduce our taxes. And if you wanted to reduce your taxes, we call them tax planning. We don't want to avoid paying taxes, but we wanted to reduce our taxes, and we call them tax planning. CCA, that's what CCA does, is reducing our taxes through the tax planning. Now, CCA deductions are discretionary. You can claim the maximum CCA, or you claim no CCA, or something in between. So you decide how much CCA to claim. Now deduct the CCA to increase the current losses. So why do you wanted to do that? You wanted to deduct maximum CCA to increase your losses. Why? Because the losses are carried back or carry forward. That's what happens. If you pay taxes previous year, you could get some of those taxes back. If you think that you could recover those taxes, we call it the losses can be carried back or forward. So this is you could carry back your losses and you can carry forward. So we have three, and depending on the situation,
So non-capital and net capital losses. So I'm not going to discuss it here because they changes every year. So any loss you have, you can carry it back or you can carry it forward. Now the other one is we were talking about recapture and terminal loss. When do we have it? So we know what we have is we have a capital cost. We call it the capital cost is another way of saying is acquisition cost. And what we do is that we take a CCA and then we minus the CCA, you come up with the CCA, a UCC, and then we take a CCA again. You keep doing it every year. So now if you have a number in your UCC, that's what we have it. So now and you if this number is a positive number, so for example you CCA is a negative and you come up with a positive number when you sold an asset. If you sold an asset and it is a you could have a positive number or you could have a negative number after you selling the asset. So what happens in this case, if you have a positive number and in order for you to close this class you needed to put a negative. If I had a positive $10,000 in my class, in order for me to close it I will have to I have to negative 10,000. If it's a negative we call it if you have to do a negative then we call it a if your UCC is a negative, you could have a negative or your UCC is a positive. So this is what they're saying here. So if you have a negative, I could have a 10,000 negative or I could have a 10,000 positive in a class. If I have to add the 10,000 here, I have to subtract it. If you have to subtract it, we call it a terminal loss. If you have to add it, we call it recapture. It only happens, recapture and terminal loss only happens if it's a last asset in the pool. If it's a last asset in the pool, no property remaining in this class, then you have a recapture or terminal loss. I'm going to be recording some homework questions at homework examples to apply the knowledge that we just learned. Thank you so much for listening to me. Take care and bye for now.